All right, let's dive into one of the most unforgiving black and white documents where family law and federal tax collide, IRS Form 8332. For any professional working in this space, you know that understanding its rules isn't optional. Getting this wrong, well, it can have some really serious blowback for your clients. And this quote from the U.S. Tax Court really just says it all, doesn't it? This is the core conflict. A state judge can bang the gavel and issue an order, but as far as the IRS is concerned, that order is just a piece of paper if it's not backed up by a properly signed federal form. So, here's how we're going to break this down. First, we'll look at that fundamental power struggle between state courts and federal tax law. Then we'll get into the nitty-gritty of the law itself, IRC Section 152. From there, we'll dissect the form, talk about why the courts offer zero wiggle room, and wrap up with what happens when things go wrong, the audit, the whipsaw, and the penalties. Okay, before we can even begin to talk about Form 8332, you have to understand the foundation it's built on. We have to look at the law that decides by default who gets to claim a child. And that all starts with Internal Revenue Code Section 152. This sets the stage for everything else. You see, the IRS starts with a very simple, almost cold, mechanical test. Who is the custodial parent? It's not about who has legal custody or what a judge has said. Treasury Regulation 1.152-4 makes it crystal clear. It's a numbers game. It is the parent the child sleeps under the roof of for the greater number of nights, period. End of story. So the natural question is, what about a perfect 50-50 split? Well, the IRS has a very rigid two-step tiebreaker for that. First, you count the nights. If it is an exact tie, which, by the way, can happen in a leap year, the law just moves on to step 2. And in that case, the parent with the higher adjusted gross income, the higher AGI, is legally declared the custodial parent. Now, stop and think about what that really means, especially for family law attorneys. This is huge. In a 50-50 physical custody split, the parent who earns less money is legally, for tax purposes, the non-custodial parent. This means they actually have no authority to sign and release the claim. They're the ones who need the form signed for them. Okay, so that brings us to the form itself. Once the law figures out who the default custodial parent is, Form 8332 becomes the one, the only, the exclusive way to legally transfer that claim. There is no plan B. This is it. And it is absolutely critical to understand what gets transferred and what doesn't. Signing this form moves the big ones, the child tax credit and other related dependent credits. But look at what stays put. The custodial parent, remember, the one with more nights, always keeps the right to file as head of household, claim the earned income tax credit, and the dependent care credit. Those benefits are non-transferable. They never move. You know, a question I hear all the time is, can't we just use the divorce decree? And the answer completely depends on this one critical date. If your decree was finalized before July 2nd, 2008, then maybe. You could attach pages from it, but only if it was unconditional and looked a lot like the form. For any decree after that date, the answer is a hard, unequivocal no. A state court order is totally irrelevant as a substitute. You must have that signed Form 8332. And this leads us to the harsh reality of what happens when these things go to court. When you look at the case law, a very clear pattern emerges. Federal tax law trumps state orders every single time. And the tax court offers no equitable relief. That means they won't bend the rules just because the situation seems unfair. The classic case here is Armstrong v. Commissioner. The father had a signed state court order from the mother giving him the exemption. But it had one fatal flaw, one little phrase, as long as the father is current with his child support. The tax court said, nope, that makes the release conditional. Form 8332 has to be an unconditional release. That one phrase blew up his entire claim. And believe me, Armstrong is not some weird one-off case. Just look at the precedent. In Hipp v. Commissioner, the court ordered the mom to sign the form, and she just didn't. The tax court told the dad, sorry, your fight isn't with us. You need to take her back to state court for contempt. In Swafford, the court was even more direct. They basically said state courts have zero jurisdiction to decide federal tax matters. The pattern here is impossible to ignore. So you have to ask, why is the law so incredibly strict? Well, it all comes down to legislative intent. Congress changed Section 152 for one big reason, to get the IRS out of the messy business of being a divorce referee. They did not want IRS agents digging through divorce decrees or trying to figure out if child support was paid on time. They wanted one simple, clean, mechanical trigger, a signed, unconditional Form 8332. So what happens when these rules aren't followed? That brings us to the audit. Because when two parents claim the same child, it's an automatic red flag for the IRS, and it leads to some pretty severe financial consequences. The IRS actually has a name for this. It's called a Whipsaw Examination. It happens when their system sees two different tax returns claiming the same kid. At that point, the IRS is forced to step in and apply those strict tiebreaker rules we talked about, counting the nights, checking the AGI, to figure out who's right and who's wrong. Now, during one of these audits, the burden of proof is completely different for each parent. The custodial parent, they just have to prove the child lived with them. They can use school records, doctor's bills, whatever. But the non-custodial parent, they have one and only one way to win. They must produce a valid, signed, and unconditional Form 8332. That's it. Their entire case lives or dies on that single piece of paper. And if the non-custodial parent can't produce that form, the pain doesn't stop at just losing the credits and having to pay back the tax. Oh no. On top of all that, the IRS can tack on a penalty. And it's a big one, 20%. This penalty has a name. It's the accuracy-related penalty, straight out of Internal Revenue Code Section 6662. And it's calculated as a direct surcharge on the exact amount of tax you should have paid in the first place. The math here is brutally simple. The penalty is 20% of the underpayment. So let's say you improperly claimed credits that saved you $2,000 on your taxes. Not only do you have to pay back that $2,000, but you could also get hit with an extra $400 penalty on top. So what actually triggers this penalty? Well, according to the code, it can be negligence, which is defined really broadly as just failing to make a reasonable attempt to follow the law, or it can be a substantial understatement of your tax. The key thing to realize is you don't have to be committing fraud. Just being wrong by relying on a court order instead of the right form can be enough to get you hit with this. Now, there is one potential escape hatch. IRC Section 6664 allows for a reasonable cause and good faith defense. And in fact, in that Armstrong case, even though he lost the credits, the court actually waived the penalty. They decided he acted in good faith, caught between two conflicting legal systems. But you can't count on this. It is a discretionary waiver from a judge, not a guaranteed right. So, after this entire technical deep dive, here's the bottom line. Form 8332 is not just another bureaucratic form to fill out. You have to think of it as the sole exclusive jurisdictional key. It's the only thing that can legally transfer thousands of dollars in tax benefits from one person to another. And that leaves us with a really important question for every professional out there. If a signed Form 8332 is completely non-negotiable for the Internal Revenue Service, why on earth should it ever be treated as a negotiable asset in a divorce settlement? That's something to seriously think about in your own practice.